What's up, guys? It's Anthony, aka on Instagram and R2R. Welcome back to the channel. As a disclaimer, before I even begin the video, this video is for educational purposes only and it is not financial advice. I'm sharing my personal experience and the exact steps that helped me become a consistent trader. Always manage your risk and never trade with real money you can't afford to lose. I was losing for years until I realized it wasn't my entries, it was actually my process. So in today's video, I'm breaking down everything that helped me finally get profitable step by step. And this is for everyone across the board. Whether you're brand new to trading and you're trying to figure out where to start from scratch, or you've been at it for a while and you just want to tighten your system as a maybe advanced trader. This video is going to walk you through the simple process that took me from being an inconsistent trader with inconsistent results to consistent profits. I'm not here to show highlights and flex wins or profits. I'm here to show you the actual process, the mistakes, the adjustments, and the daily habits that built consistency. So if you've ever felt like you're missing something that keeps holding you back, stick around because by the end of this video, you'll have a clear roadmap to follow from confusion to consistency. And if you want to even go, deeper, I'll drop the link to my free Discord down below. That's where I post free education, weekly breakdowns, and updates for, anyone who's serious about improving their trading. All right, so let's get into it. Okay, so as a second disclaimer, before, we get started, just so that, I don't waste certain people's time, if you're looking for some get rich quick shortcut, this is probably not the best place for you. But if you're serious about this, about learning how to trade, or even, how it was personally for my journey from being inconsistent to now consistently profitable, if that's you, then you're in the right place. So I just want to put that out there before, getting started, just so that I don't waste anybody's time. Also, there's concepts that I've been going based off of, and these have been inspired by Mark Douglas, Darren Hardy, Seikoda. Um, so hear me out. If so trading it's not about being right, it's about, following your rules over and over until consistency compounds. And discipline, it's not some exciting venture, but it's the bridge between randomness and results. So I took that and I just, started running with it, and it's been a game changer, and the results are now showing. It's now showing in my profit and loss statements. So let's get started. I'm gonna pull up TradingView so that I can start jotting down information. Um, and also I'm gonna use Google for my advantage so that I can put this into a little bit of a more bigger perspective. I'm also gonna implement analogies that I feel like you guys might be able to grasp. I think I'm a visual learner, so I just assume everybody else is. I'm gonna implement like um, you know, imagery so that you guys can see where I'm coming from. And I'm also gonna search up specific things that I've learned and read about that I think would like create a mental framework to give you a better idea on, how to kind of get from point A to B quicker than others. So let me start sharing my screen first. Let me look this up first. Um, okay, so we're on Google, right? I'm gonna share my screen next. I think this is it. Okay. So right now we're looking at this picture right here. All right. So this picture right here, I searched it up on Google. It says sellers, right? Sellers go right, buyers go left. In the market, it's pretty much going to be, buyers are going up, sellers are going down, right? Buyers, let's say buyers up, sellers down. All right. Buyer's market. Let's search up buyer's market. So there's two different types of people, right? It's either you want to be a, let's look at this picture right here. It's either you want to be the person anticipating you in a downtrend, which is going to be a seller, so you maybe be selling from up here, or you want to be a buyer buying from around here so that you can profit on the uptrend. Most people probably think that when you're trading, you can only profit when the market goes up. But the way that I've been trading, um, is, with trading commodities and indices, um, you can profit from shorting the market. Shorting would be you think that the market's going to go bearish or downtrend to profit when the move starts going down, the market starts going down. Or if you anticipate, um, the move going up in an uptrend, you want to profit by buying the market because you feel like the market's going to go up. So those are the two types of people in the market, and there's really no in between. It's realistically just you buy the market or you sell the market from where the price is at, or I'll get into like buy limits and stuff like that uh, afterwards. And let's talk about um, buy. Actually, I'll save that for later. So I searched up shark and fish. You probably know why if you're an advanced trader here, but for the beginners, um, you want to think like you want to try to put yourself in the shoes of the shark, or not even the shark, the fish, right? You don't want to be a lone fish, not and like just by yourself. You want to be with the big fish. You don't want to be with the small fish, like the retail traders. You want to trade in the direction that the big fish is moving. This is almost like when I first got introduced to trading. This actually helped me with imagery somewhat understand um, to trade with the trend instead of against the trend. Because why would you want to trade against the trend, right? If there's bigger players in the market and you can visually get an idea of somewhat of the direction of where the market is going just by market structure, that'll help you um, have a higher win rate or a probability on being on the right side of the market opposed to being on the wrong side of the market. So you can picture this shark as um you can picture these sharks as like hedge funds, institutions, inside traders. They have, usually have more money than retail traders. On average, these sharks, they're the ones that are usually moving the markets. Um, so just keep that in mind. Retail traders probably take up only 5% of the market's liquidity. So just keep that also in mind, which is why you would most likely want to be on the side right besides, the big fish like the sharks, hedge funds, institutions, and inside traders. Um, with that being said, we can roll directly into getting started. So getting started, I'm gonna pull up I'm gonna pull up TradingView. So TradingView, we're gonna make a list here. All right. Specifically, this is definitely gonna help the people who are getting started from scratch. So, um, in my opinion, since this is not financial advice, I personally don't use a regulated broker. Um, my brokers are usually unregulated, but um, for educational purposes only, I think, since this is a public video, my advice, use a regulated broker. And I would I would say do your due diligence if you're looking for a regulated broker, find one that's licensed. Um, I'm not gonna name names. This isn't a video to promote any brokers and stuff like that. This is not a paid partnership, paid promotional video. So just keep that in mind. So first step would be to find a reliable broker. All right, find a reliable broker. Um, find a reliable broker. So let's talk about what a broker even is. So the broker is, in my terms, I'm going to just say my terms because I'm not going to start doing the whole thing where we start going into specific definitions and stuff like that. And you don't have to know everything to start being profitable. So just keep that also in mind. This is an authentic video um, that I'm looking to do. I might make errors and stuff like that, but this is going to be from what I have been going based off of over the last 6 years of me trading. So, in my definition of a broker would be um, almost the way that I picture it as a warehouse. I think of it as a warehouse that is allowing you to, you know, um, be the middleman between you and a trading platform such as MT5. So MT5 would be a trading platform that allows you to click buy and sell for your trades. Okay. So finding a reliable broker would be what I would think is the first step. And so we can just do like, I would say in my terms, a warehouse that um middleman's you to a trading platform so that you can buy or sell. Okay. And there's a few different ways that we can go about, like in terms of, um, saying buy or sell. So I'll put that right here. So let's say it's just so that you can get more, terminology, because a lot of times you'll hear people say, buy the market, that'll be up, right? Um, Uptrend. These are just different types of ways to think about it. So you want to buy the market's gonna go up, the market is in an uptrend now. Um, Another one is bullish. So these are a few things to think about. I'm gonna copy this, paste this right beside it, and then we're just gonna do the complete opposite for sells. So if we're wanting to sell the market, that's gonna be we think the market's going down, the market is in a downtrend instead, and then we're looking at a bearish market, right? So with that being said, we're going back to number step two. So step two would be, think about this real quick. Because this is gonna be right off the dome where we're creating this video. So step two would be, um, let's go with symbols. So the symbols that I'm trading are gonna be NASDAQ, silver, gold, UK 100, and the S&P 500. So these different securities that I'm looking at, uh, these are gonna be tradable securities. And let's say gold and silver, these are going to be considered commodities, metals. So I'm going to say choosing what you want to trade. Um, and then NQ, UK 100, ES, those are going to be indices, okay? So choosing what you want to trade. You have FX, you have indices, you have commodities, things like that. So it's all up to you on what you want to trade. Thereafter is going to be understanding. I want to go, I've been waiting for this. I want to go over price. Okay. So many people don't understand how price even works, right? Here's how price works. Okay. What I'll do is I'll put candlestick anatomy. Also, if you want the book that I recommend, the specific book that I recommend to read about candlestick anatomy, I can't exactly remember the name of it. It's in my trading floor Discord link in the education hub section. So if you want to know the exact book, I can't remember off the top of my head. Check the Education Hub section. The Discord link is should be in the description down below. So just understanding a little bit about candlestick anatomy in the way that I interpret it is gonna be um here, let me okay. All right. So let's do a buy a buyer's candlestick would look, right? And you can have your settings set as green, blue, doesn't matter. It could be red for blue, but I'm just gonna get into, how I would interpret the market for a beginner. Okay, so style. Let's choose let's choose blue. All right, I'm gonna up the opacity on that so that it kind of makes it a little bit more clean. And then what I'll do is buy candle. I'm gonna just create this so that I don't have to keep on, going in and out, excuse me, and then seller's candle as red. Okay, so okay, so first and foremost, this is TradingView. Sorry if I haven't mentioned that. So TradingView allows you to look at, the market. I've been using TradingView. I haven't used anything else. I'm not comfortable with any other platform. Um, I've been using this for years. So TradingView, I think I have the first subscription so that I can, set alerts. I use the alerts right here for where I want price to um mark out price so that I'm aware of the market or a little bit more alert. Um, I'll get the notification at my phone, my computer. They'll make, this pinging sound, um, and so that I know that price is at a specific area. For me to start looking out for the market to maybe shift in structure or break structure. So yeah. But you can go with the free version. You don't have to, pay. Just disclaimer. So yeah, let's identify let's identify a buying candle first, and then I'll identify right next to it the seller's candle. Okay, so what we're gonna do is identify that the top of this blue candle, this buyer's candle, oh, is the candle's close. Here is the candle's open. The open of the candle. All right. Um, here is the high of the candle. I'm like so prestigious that if all the other letters are not capitalized, I won't capitalize any other letters. And then this is the low. If you have to pause this video to understand these concepts, pause the video. Now, rule of thumb, I don't know who came up with this, but I just ran with it. I have a lot of like concepts and mental frameworks that I keep in my head from things that I've read and stuff like that. This one stuck with me, so it's gonna be Wicks do the damage, bodies tell the story. Okay, so I ran with that, and it's been helpful ever since. Traders call this the body. So this would be like many traders call this the body of the candle. I keep forgetting that okay, so this would be the body. Like this whole structure here is gonna be the body. Okay? These are gonna be called the wick of the candle. This is gonna be the wick of the candle. So this right here is the wick. This is the wick. I'm gonna go a little bit more in depth so that you know why candles become blue as a buying candle, why candles become red as the red candle or the seller's candle. Just right after I get into how this is structured to be a seller's candle. Make sure you guys can hear me because I don't want to do this whole video without you guys being able to hear me. One second. Okay. Hello, 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 hello. Oh, okay. Yeah, I almost got paranoid. Like, there's no way that I made this video and they couldn't hear me all this time. All right, so we're right now looking at the seller's candle, the sell candle, the bearish candle. Okay. This is gonna be the open and close, so it's the opposite. Okay. This is gonna be open. This is gonna be the close. And hopefully in this video, you don't have to watch any other video. Hopefully this is the first and last video that helps you become an inconsistent trader, like I said earlier, to a consistent trader, even if you're brand new to the space or completely advanced trader in the space, just haven't found that consistency yet. Maybe you're just looking for a little bit more of an edge, and hopefully you find something in this video that's helpful. Um, this is gonna be a high, or yeah, still a high. All right, and then vice versa, we're gonna use this as the body, okay? This entire structure here. The entire red is the body, the body of the candle. Now let's start identifying why these candles become blue or why these candles become bullish and why these candles become red, why they become bearish candles, okay? This is going to be the buyers, this is going to be the sellers. This candle indicates that at the present time of it being formed, there's been more buyers in the markets than sellers. In this case, this candle indicates that at the present time of the market, present market in the current time frame, there's been more sellers than buyers. Now, sometimes you might get a candle that realistically looks just or pretty similar to this. Literally, you'll see some candles look like a plus sign. This indicates that it was a perfect balance between buyers and sellers. So it's almost like they 50-50 the market at this moment. So it could be the daily candle you're looking at. It really just depends. Where you can't even understand whether, there's been more buyers or sellers. So not, sometimes you'll see this. I believe this is a doji candle. I might be mistaken, but we can check while we're on the topic. Um Here, let me pull it up. Doji candle. Oh, well, here's It's a doji star, so that's what it's called. This is a long-legged doji. This is a dragonfly doji, gravestone doji, floor price doji. I don't want to get it too complicated for, starters, but if you like I said, if you want to learn a little bit more about the candlesticks, just search up the book that I had mentioned in the Education Hub section in the Discord. Um, moving on. So back to the trading view. Okay, so here's where things I hope doesn't get, more complicated than, what I've listed here. This should be straightforward, but now let's talk about it. All right, so we're gonna look at, let's say this current price right here is bullish. Okay, we got a buy candle here. We've got the market came up here, and we're looking at, let's say we're looking at a 15-minute candle, right? It's 9 o'clock right now. Okay. So the last 15 minutes of before 9 o'clock, so 15 minutes before 9 p.m., there's been more buyers than sellers. So this is going to be the most recent 15-minute candle and how it looks, for example. Now, since the market previously opened here and closed here, um, the next candle I'm going to give you in terms of how the market, because there's a language in the markets. And if you don't know the language, it's going to be very hard for you to comprehend whether price might go down or price might go up. So, to help you comprehend if the market may go up or down next, or maybe, shortly, you'll see that, price, the next candle should open here. If there's no gap in the market, it's pretty standard to have the next candle open here, right? So market opens here. Okay. Um, once market opens here, the color of the next candle will be determined after the close. So you'll see that the market might say, let's say if the market dips underneath the close and it goes to, you can see, look to the all the way to the right, you'll see price. Okay, so if you see that the market, the next 15 minutes, this is gonna be the 9:15 candle. If it dips down to 34, let's say 34 flat, right? 3400.0. It'll create a wick for this next 15-minute candle. So I'm gonna create that wick. What did I say? 3400. So 3400 is gonna be right down, right around here. Okay. And we're gonna get that body of that candle here because it came down. And let's say this is the furthest the candle came down was to 3400. All right. Furthest it came down was 3400. Oh, here's the wick. Um, now the market comes down to that point, all the way down to 3400. It doesn't go any further, and then it stops there. But then now, when the market is below the close of the previous candle, you'll see that this is actually not going to be a seller's candle or buyer's candle. It's going to be a seller's candle. So it's going to have a color change if your trading view or trading platform um, is set to a specific color for, sellers and buyers. For educational purposes, I'm making it red for sellers to keep it simple, blue for buyers. Now, once it goes above the recent close, the color of the candle changes from red to now blue. So it becomes a buyer seller. Now there's more buyers in the market, it indicates for the next 15-minute candle. Um, so this is going to be a 15-minute candle. If it stretches and it goes all the way to 34.80, then does a pullback and within this 15-minute candle, it's going to be at and closes at 34.70. So the 9:15 candle, it'll close at 34.70. You're going to see the wick stop at the 34.80. 34.80. So this is going to determine whether the next candle, this is the next candle, becomes a buyer's candle or a seller's candle. Okay. Vice versa. If you get the next candle to open here at the close and goes up, it pulls up above the candle's wick, or just as long as it's above the candle's open, it'll be show you that there's more buyers in the market. If it stops at 3,500, right? There's gonna be a wick at 3,500 that's created for the next 15 minutes. So this is gonna be the 9:30 candle that's forming now. But now let's say the candle starts dropping. As soon as it starts dropping, now we know that there's going to be more sellers in the market. And you don't know for sure for this time frame if there's more buyers or sellers at this very moment until um the market, closes, the candle closes due to the time frame you're on. So again, we're on the 15-minute time frame, okay? Now that the market has dipped below the open of the or the close of the previous candle, this candle, the market is now changing from blue to red, seller's candle. Now we're going bearish, okay? And then at 9, this is a 9:30 candle, right? This was the 15 minutes before 9 o'clock candle. So this is the 8:45 to 9 o'clock candle that closed. So the 9 o'clock. This is the 9:15 candle. Now, what's currently forming right now is the 9:30 candle. Now, let's say the market dips down to 33.80 and then jumps back to close at 9:30, 3,400 flat. We're gonna get that wick because that was the lowest price is gone for that 9:30 candle, 33.80, somewhere around there. So this is how, price is structured, okay? And just so that you guys are aware, I'm gonna say let's talk about it since we're on the topic of candle structure. You can see that this candle, it engulfs the most recent candle, fully engulfing the most recent candle. Um, yeah. Yeah, so you can see that this candle is hovering over this entire candle right here, which means that we're likely to start going down. Okay. This is an this is what many traders call an engulfed. An engulfed or engulfing candle. Very important. Engulfing candle or engulfed candle, which would be this red one right here. Vice versa for blue, if it was blue, right? And but yeah, good for trading reversals, okay? Um what what I want to talk about next is let's talk about common issues that I've came across. And in order to keep it, shorter for many traders that are watching this video, I want you guys to understand my failures so that you don't have to, go through the same thing. Um, I think that I would much rather listen to, no matter what industry in, real estate, insurance, music industry, healthcare, any industry, sports industry, entertainment industry, I would much rather listen to someone's a successful person, not an unsuccessful person, but a successful person's journey and process of their losses that they took, so that I know what to look out for, and it cuts the amount of time at least in half for me, versus just hearing, about the wins. because the person didn't become who they became as a successful person in this space or industry by only knowing how to win. They usually became this successful product person, influencer, entertainer by taking their L's and allowing there to be mental blocks so that they don't continuously bump into the bad habits or losing ideas and habits that they had before. So I just that's my take on, that's my take on it. So let's talk about let me find just so that I know what we've already gone over or what to expect. All right, so let's talk about I'm gonna move this here. One, two, three. We've gone over a little bit about candlestick anatomy. Honestly, that was a lot about candlestick anatomy. It didn't really feel short. Next is going to be mistakes. Mistakes or mistakes or failures. Mistakes or failures. Okay. All right, so I'm going to make a list. Okay, so mistakes or failures. We're talking about making a list under here. So, um, hmm, you know what? I'm thinking that it wouldn't be fair for me to go over mistakes and failures if I don't go over the basic things first. So here's what I'll do. I'll put this as 5 and I think it's fair for, starters, excuse me, for me to at least go over. I'm sure everybody's gonna understand. Even the advanced traders are gonna understand why I should list for number 4, buy or instant for instant execution, buy limit, sell limit. So instant execution, buy limit, sell limit, buy stop, sell stop. Okay. Then we can talk about mistakes or failures. And then since it's on my mind, I'm gonna just list it, get it out the way just in case I forget. We're gonna go over what AMD is. Stick around if you want to know what AMD is, or personally how I think about it. So let's talk about instant execution, buy limit, sell limit, and buy stops. I'm gonna copy this, paste it, drag it alongside so that we don't forget. I'll give you an example of an instant execution. Okay. So an instant, oh, yeah, instant execution is gonna be when, let's say I find a reason to, we're looking at the market at around Monday, 25th, August 25 or 2025. How about how about I do, let me just remember the date of where I've listed these stuff. This is gonna be October, so I shouldn't lose it. Okay. Let's say we got a reason here, okay? Mm, maybe a little bit more of an easier one would be to understand here. Okay, so let's say we're looking at price and price is created, a low, a high, a low. and a high. We're probably going to expect price to come back and create another low so that we can expect um, to do create an instant execution here and profit on the market going up since the market has been making higher highs and higher lows. That's something we also want to talk about. I'm sorry if I'm getting too carried away with these different orders. Um, what I should have done was made this a little bit more pre-planned. Let's do 6, 7, 6, 7. I had to do that. I'm sorry, guys. I don't even know where that. I just been hearing that. All right, let's go with number 5 being highs, high low. Okay, determining highs and lows. Okay. All right, where were we? We were here. Right now we're just talking about instant executions, buy limits, sell limits, buy stops, and sell stops. So let's go over instant execution first. Instant execution. And instant execution would say, hey, if we see that the market's been creating lows, highs, think of it as a staircase, right? I'm gonna pull out a staircase. So you see a staircase, any staircase. Let's pick this staircase. This staircase is taking you from downstairs to upstairs. More buyers are in the market. Um, this is bullish. We're going upstairs. It's college, right? You don't have classes on the first floor for second period. It's for second period, right? It's for second period you have to go upstairs on the second floor or second floor. So from going from point A to B in the market we're currently in, there's more buyers, right? There's more people going upstairs than downstairs. This just to get a little bit more of a better picture in how the market typically works. Uptrend, so you're looking for reasons to buy. Reason to buy would be what's called a pullback. So this would be a pullback if the market comes back, how it did here. Pullback and pullback. Okay? So pullback, 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 right? The market's pulling back after creating a newer high. The reason you can identify newer highs being created is if the market's closing above the wicks. So that's a pretty easy way to look at the market is by seeing where the next high is closing at. All right. So the market's closing higher than the wicks. Okay. Um Now before getting into time frames, just because we're still in the starters um series of this video, we're gonna again start with the man, it must have printed out over here. Instant execution. So as an instant execution, and this is gonna be inside of this should be inside of your trading platform. You should be able to see the button that says instant execution. So your trading platform should allow you to uh click the button instant execution so that once let's say price comes to let's say we scale down to a 15-minute time frame. We look left and we see that in historically, price has came down to about I'm gonna consider this as an area of interest. So let's say here on a 15-minute spectrum, I'm gonna remove the background. One, two, three. All right, so hmm, hmm. What's that video not here? Oh shit. It's gotta be here. Oh, fuck. It's Sunday, October 20. October 24th. October 24th. Come on, there's no way I just. Come on, bro. Fuck. Fucking. Damn. Did I send it to anybody? Fuck. You're joking. Hmm. Hmm. When was this picture taken? Shit, I think this has it. Oh, fuck. I think we're in the money. October 24th. Fuck. December. November. Closer. Oh my God. What the fuck? Are you dead ass? Fuck. Videos. Video. Oh, fuck. You dead ass? How's there no videos? No videos in here? Oh my God. Fuck you. No, seriously, fuck you. Oh my God. All right. Wait. Okay, so I paused the video to give credit where credit is due on the way that like one of the confirmations that I've held on to and implemented into my trading system or model, the way that I trade now, is I look to the left to look for, history, like I said. And now I've been including this into my confirmation model or list. Um, it was influenced to me by Alex G. Okay. So, long story short, Alex last year in 2024, we're in 2025 right now, it's October. He had did like 100 to $1 million dollar challenge, and he said that he would create a boot camp for traders, certain amount of traders if he was able to get the job done. Um so he did he what he did was he said as soon as he, finished and stuff like that with the challenge, he would open up this like page where you can submit applications and stuff to apply. So I remember I was at the airport and I clicked submit on the application and stuff like that. Um, and then when I was coming back, I had I had told myself like if only way honestly that I'm gonna join is if, I get a phone call from this guy. It was like it was a couple $1,000 course. So I was like, only at this point, only way that, I'm gonna take this guy's advice and join his uh course is if I get a phone call. So this random day that I came back to Florida and I was working in the office because for a background, if you guys don't already know, I've done, insurance for like 4 years, sales. So I was coming back from the office and it was just like you know, I was getting food. So I stopped home and then my phone started ringing, but it was a FaceTime call. And I'm like, who's this random, Joe Schmo number calling my phones? So then I picked it up and what do you know? It was Alex G himself. So I was like, wow, okay, so this is more legit than I thought it was, I guess. This obviously doesn't, really prove anything though, just to get a phone call. But I made a promise to myself, and the promise that I made to myself, a commitment that I made to myself, was only if, under the condition that I get a phone call from this guy Alex, who runs this, boot camp after the 1 million, 100 to a million. Only if I get this phone call, I will. It didn't even have to be, a FaceTime call. It could have been a mobile phone call directly though, as long as it was him. Um, but yeah, I get a FaceTime call from Alex. He's like, "Hey man, I see like, you wanted a jet." Because one of the things that, throughout if you guys applied, if you applied to be in the boot camp, then you know what I'm referring to. Because there was a key phrase that you had to have, almost like a passcode, that he wanted you to use when you're applying for his, 100 to $1 million boot camp. And the phrase that I used was jet. So he says, this is before he gets his set and forget jet. He's like, "Hey man, I seen that you and this is probably what caught his interest about the jet because at this time, since I think he got his jet in 2025 this year. This was 2024 before. I think this was definitely before he got his jet. So, who knows, maybe he already was thinking about, getting a jet or who knows, maybe I inspired him to get a jet. But my key phrase was jet. So maybe that's what caught his attention to give me a call. And I was like, he was like, yeah, I seen your key phrase was jet. Your key phrase was jet, right? I was like, yes. He was like, why was it jet? Do you want a jet one day? I was like, yeah, I could use a jet someday. I want a jet someday. He's like, that's cool. Okay. And then he started asking me like, a background of myself and what's the position I'm in right now and stuff like that. I told him I'm doing insurance and stuff like that. And then Um, and then, things went from there. I ended up enrolling into the boot camp and, I took some concepts and, I'm sharing some with you guys. So this is one of the key concepts, probably one of the most important concepts that I gained or learned from uh his his course, okay? Um, so if I were you, I would pay attention to because, it was not just Alex G's, course and stuff like that that I've personally went through, but there's been, I spent thousands of dollars learning, how to trade and stuff like that. Even in expenses of losing money in the markets, which is gonna come in. I'll let you know, like, how I would not going forward lose money in the markets by not making the same mistakes that have taken. So again, back to instant execution. Thank you guys for being patient, though. I know I went on a little bit of a rant. I'm just getting a little bit more personal, just so that you guys can get a little bit more of an idea of why I am a bit obsessed with the markets. Okay. Um, at this point. We got one, we got two, we got three indications of the markets. at this area of interest. Okay. Now, usually I look for as many, um, as many as I can, uh, of this price level of around like 3,500 being important, or 3,550 being important, 3,540 being important. You know what I mean? One, two, three. It's been pretty respected, or it's been, yeah, pretty respective, right? This is it hitting this zone right here, and then it breaks out, retests it right here. Now it comes back, it's probably going to be a floor. Instead of being resistance, it'll be support. So this would be resistance, 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 breaking structure. Now support right here after the break of structure, and then it might support this floor as well once it comes back. So let's say you find a reason to buy here. These are the reasons that you want to buy. Obviously, the reason that you're looking to buy is because we're in an uptrend. The market just keeps on making higher highs. I'm going to talk about higher highs and higher lows after this. But yeah, you find reasons to buy the market once the market comes here. Let's say, you're looking for the market once it comes in this area. You find reasons on the lower time frame. I'm not going to get into the lower time frames and stuff like that until further down the line. But for now, to keep it short, sweet, and simple for especially the starters, um, you wait until the market comes to this area. I'm going to actually slow this down, and I'm going to remove that. So the price here is 35.51. All right. So we wait until the market gets to 35.51. All right. Boom. Okay. We get price at 35.51, right? Now it comes even further. I paused it so that we can get a better understanding. Let's say for simple purposes, we choose 35.48 just to get a better risk to reward. I'm going to talk about that as well. And then this is the low of the structure point. Now, this is our stop loss, okay? This is a tool that I use for determining the risk to reward. If we were to take price at this point of where it came down to at 35.48, we would have entered when as soon as the market got to this price, that would be an instant execution. We would click the buy button, okay? And then we would set the price at 35.35. This would be our stop loss, all right? This would be our take profit. So this is instant execution price as a buy. That would be the the in between area. That's why it's, green and red in the like right there. Um, this would be your stop loss. This is your take profit. So this is how it looks as a tool when you're looking to buy the market. Vice versa, it'll look a bit different if you were to how do I put that up? Dock to up. All right, I don't know why that's. Oh, okay. All right, so vice versa, if we were to short the market, it'll look like that. All right, just upside down. Um, so yeah, this is our stop loss, take profit. I'm anticipating, since price was respected as a support level, right? Acting as a floor. Remember, we're looking at a staircase here, so we're thinking the market's gonna it's bullish, so we're looking for reasons to buy. Once it comes back to this point of interest, we say if the market, this stop loss is there so that if the market brings itself all the way down past this area right here, we're most likely expected to see the market continue down, breaking structure. So usually you want a stop loss in place to keep risk management under control so that you're not, losing more than you want, or losing more than what you expect. Okay. Losing more than what you're comfortable with. Okay. So instead of losing $100 all the way down here, you're losing $50, depending on your, equity. Okay. So yeah, I'm gonna delete that, but Now that price has came to this point, as soon as price hits that price, right there, now you're in. Okay, as an instant execution, you're in for the buy. Okay, so step by step, we're gonna look at each 15-minute candle one by one. Market tanks. All right. Let me stop this video. It was super close to hitting your stop loss, but it did not. So this means you're still in the market. If we zoom in to how close the market has came, you can see the market stopped. I need uh I'm looking for the okay. This is the lowest the market has stopped at this 15-minute candle right here. The 4 o'clock candle. But your stop loss is here. 35, 35. Another thing that I use is if you hold down on the price at this point, you'll see it'll pop up on TradingView with details. So the low of this candle was 35, 37.5. Now, it would have taken you out if it hit 35, 35 point 6, but it didn't. So now that that happens, boom, market starts going up, and if it hits, your take profit, then, you're automatically going to be taken out of the markets. And all right, I'm going to speed this up because we virtually already know what's going to happen. So price kind of got a little bit closer again. Okay, so now TP hit, right? Take profit hit. Another thing that we want to understand is that TP usually is in reference to or meaningful for take profit, and SL would usually be stop loss. Okay. Just so we're on the same page, in case I use this terminology down the road in this video. Now, that's instant execution. Okay. I'm going to use the same idea. I'm not going to change anything uh, in terms of setups. I'm going to use the same setup. Now, if we were to use a buy limit on your trading platform, such as, MT5, let's say you're using MT5 and you're going to sleep, right? I'm going to go over, this is a perfect time to discuss Asian, London, and New York session, right? Asian session, if you're Eastern time, matter of fact, just so I don't get the times wrong. Asian, New York, London sessions or session. Mm, I'm Eastern time, so trying to make sure my Eastern people are on the same page. Perfect. Market hours. So these are different sessions that happen throughout the day, right? So from 7 p.m. to 7 or 7 p.m. to 4 a.m. it's Tokyo Asian session. Sydney session is 5 p.m. to 2 a.m. London session, European sessions 3 a.m. to 12 p.m. New York session is 8 a.m. to 5 p.m. Eastern time. So usually there's going to be kill zones. Kill zones would be when two different markets overlap each other. In this case, for London session or Asian session and London session, they overlap at 3 a.m., which is why there's a lot of volatility in the markets. Volatility, you'll hear a lot of traders use the word volatility, just so that you understand that there's a lot of money being moved around in the markets. And when volatility occurs in the markets, that's usually the reasons why you can profit as a trader or as a hedge fund through volatility, movement in price. So just keep that in mind. So yeah, let's say it's Asian session. Usually traders know Asian session as a slow type of moving, um, typically a slow mo type of moving time zone. So for Asian session, mm, we're gonna put an emoji. The emoji we're gonna use is a turtle. It's not always slow, but the way that I interpret the market during Asian session and most other traders interpret the market is usually slow. Okay. London session is going to be different. All right. Um, let's say London session is maybe a bit faster. So I'm going to put, let's do, let's use this emoji right here. I'm going to break this up so that, so Asian, London, 24, New York session. Guess what we're going to do for New York session? Just guess. I think you got an idea. You're like, hey, what's faster than a turtle? Like, what's faster than running? Hmm, maybe a car. Okay, race car. All right. So this is how me, as well as most other traders, so most other traders and I, on average, probably interpret the markets. Asian session typically slow, turtle-like. Don't quote me on this because sometimes, we don't have control over the markets, especially as I said realtor, retail traders. We make up about 5% of the market. So keep that in mind. Um, Price can do anything that it wants at any given time. So just keep that in mind as well. So yeah, Asian session, typically we're gonna just put the turtle right there. London session, bit quicker than, Asian session. Could be by a lot. And then New York session, also fast as well. In most cases, many traders and I assume New York session moves quicker than London session. Okay. Um, to make the high of the day or to make the low, to finish off with the low of the day. Okay. London session in many cases as well, though, is also food for thought used to create the low or the high of the day. And then sometimes, right, in many traders' vision and concepts, Asian session sometimes is used for the low or the high of the day. Not as much as London and New York. So take profit and stop loss. We went over that. We went over instant execution. See. We're gonna go over now buy limit and sell limits. Then buy stops, sell stops. So we're gonna use the same structure. All right. Same structure, same idea. let's say we still anticipate at the same point, instead of using an instant execution, we're going to use what's called a buy limit. So the buy limit, we're using, we're looking at the markets. I don't know if this is anybody. I think this is a great analogy for this since I went in depth with these different sessions, common sessions that traders interpret the market. So now we're looking at the market at this time. We're about to go to sleep, and let's say we're this is Asian session. We're about to go to sleep. We got work in the morning, or we got to get up early for whatever reason, and you say, "Hey, I found that we're here. Market's here. It looks like we're headed towards my area of interest, and I just think that the market is gonna create a higher high. So I feel like, the market might respect this as a floor again, as a resistance, um, or not resistance, support, since we're below price right now. Um, so as support, I think that once price hits, and then I choose a specific price, the specific price in a buy limit, would be limit means, there's a cap. So, or not cap. Maybe limit would be maybe as soon as price hits in trading terms, as soon as price hits this price, enter me in the markets. So you're using specific numbers, okay? You're going to type this into your trading platform, for example, MT5. MT5, we're going to do, let's say your stop loss is still going to be 35.6 as your stop loss. SL. Now this is numbers you're typing into your order once you're placing your order. Order buy limit is at the same price right here. 35.48.4. So 35.48.4. And then we're gonna have a take profit. Take profit order. Take. Eh, really don't need that. Take profit. How you do one thing is how you do everything. I had to correct my uppercase, lowercase. Perfect. So now this is our take profit. Let's say we go to sleep. We're going to sleep at 9 p.m., 9 at night. Market, this is for example purposes. This 15-minute candle here, it's 9 o'clock at night. And we got to go to, bed uh early because we got to wake up in the morning early. We're not going to be up for London session. And London session, is going to be the overlap is going to be 3 a.m., which is why there's a lot of volatility. Moral of the story, we're not going to be up and we wake up at maybe 8 o'clock in the morning. So we're setting the buy order limit so that once price gets to this point, it automatically enters us in the market. However, since we're sleeping, if price gets to this point, uh, once we're sleeping, we don't have control over, or we still have control. We still have control over continuing to be in this uh in the market as a buyer until with a condition. The condition is if the market hits this price point, then we're no longer in the trade and we lose. But we'll be held in the trade if it doesn't, if it enters us in the market at this price, doesn't hit that price of 35.6 as our stop loss, but it enters us at least in the market, and then, you know, from there it goes up. So as long as we're above the price of 3548.4, we're in profit. Unless you got like spread. But for the most part, above we're in profit, below the price of 35.48, we are in drawdown. Drawdown is in other words for being, negative equity, having some risk. So drawdown is risk, okay? In other words. Um, all right, so fast forward. We're sleeping at this point. Now, the alert just freaked me out. Um, because I have alerts set on gold. Okay, look, boom. Market wicks us into this area right here. Now we're in the market while we're sleeping. Again, this is while we're sleeping. This is the order limit that I'm explaining. Now the market starts to move. I'm gonna fast forward this. We already know a little bit about what's, happening right now. Boom, right? Let's say London session. This is a London session candle at 3 o'clock. Price goes this low, doesn't go lower than here, this low right there, and then price starts moving in our favor, which would be, up because we're buyers using the buy limit at this price. And this is all while we're sleeping. All right. Notice, okay, I was actually giving you guys an example, but this is actually realistically happening. Like I never even marked up this price before. Like I on the video, I decided to use this, and it's actually working exactly in the realm of what I was referring to. Like around this price is Asian session, and then we get down to you can see the time. Or if we look at the bottom, you can see like the time here. So around that point on, it's Asian session. We get the overlap at 3. So 3 o'clock is here. 3 o'clock is here. Price around 3:45. This is 3:45 candle. This is during London session while we're sleeping. In the morning, 3:45 in the morning, you get price to come down around here, right? 4 o'clock starts going up for London session. Then we're getting closer to New York session. Again, New York session is 8 a.m. Okay. So the 8 a.m. candle is here. We get the spike up. It's a bearish candle. We start going down. For 8:30, the market gets more volatile. It's like a kill zone. So 8:30 is this candle right here. Now we start pushing price up. Price starts actually moving. Not that it wasn't moving before, but it starts moving this time. Okay. And that's where you get price to hit your take profit. Now, once price hits your take profit, you immediately exit the market. So your trading platform should close your trade, and allow you to, make money on this move. All right. So this should simplify as a sell as an order a sell limit for an order as a sell limit. It'll be the complete opposite. Complete opposite. So you're looking just vice versa. It's just gonna be a downtrend. Um, looking as a downtrend, you're looking for a sell limit, a reason to sell. All right. Looking for same types of confirmations. Um, now, since we're on the topic, I'm gonna go over, I think I already addressed the next topic, which is, I believe, highs and lows. Yeah, highs and lows. Oh, we didn't even go over buy stop, sell stop. I personally don't use buy stops and sell stops, but because I wrote it down, I'll tell you guys. So buy stop or yeah, buy stops means you're pretty much just entering the market as soon as it price hits. Let's say this is your buy stop. I'm gonna just say vice versa so that we don't have to take too much time up on repeating the same things, just vice versa for a sell stop, okay? And instant execution sell stops, or sell limits for instant execution. So this is a buy stop. Buy stop would say, hey, once the market, uh, you know what? What I'll do is, yeah, I'll use, I'll use the same area here. 15. We're gonna go back to the 15-minute time frame. By the way, these are different time frames to view the candle. I'll go into this a little bit later. So right now we're looking at price right here. All right. Price has came around this area and let's say we're up during London session, right? Around London session. What does it say? London session is between 3 a.m. and 12 p.m. Okay. So this means that all this time right here, we're in London session. Let's say I find the reasons and stuff like that. I feel like once price touches this point right here, from where it's at right now, once it becomes 3550.8, that's the price that I want. 3550.8. This is my buy stop. That's a buy stop order. I use the same exact 35.6 stop loss. I'm gonna exchange this for buy stop. So this is gonna be a buy stop. Price for this is gonna be 3550.8. And then I'll give you guys the meaning. Same thing, right? Same thing. Take profit is the same, stop loss is the same. This means once the market from where it's at does whatever it wants in this area, as long as it doesn't hit your stop loss, you'll get activated. The market, your trading platform will activate you and allow you to participate as a buyer in this market. Since it's a buy stop and not a sell stop, you will now be buying as soon as the market hits you in for 3550.8, meaning that's when you'll start to participate in the buy as a buyer in the market. So look, boom, I'll let you know when you guys get activated. Boom. Now you're activated because the market touches that area and you are participating as a buyer in the market from the time that you touch that price until either the market has hit your stop loss or the market hits your take profit. As long as you have a stop loss and a take profit price, then under those rules, X will happen. All right. So yeah, vice versa. Okay. If you do the a different thing, the opposite, it's gonna be sell stop, but the stop loss and take profit, I'll explain next. I'll explain highs and lows. All right. So, um, first of all, let's talk about it's gonna be market structure. So market structure components under market structure, we have high, we have This is interpreting the market. This is like market structure market structure language 101. Market structure hub 101. Higher or lower, so lower, low. Perfect. These are the conditions. Now, if we're in an uptrend, right? We're going upstairs. We're starting from the first floor to the second floor, or we're starting from the second floor to the third floor. Really doesn't matter what floor you're on, as long as you know you can interpret this, then it should be helpful. So if you look at this market, it should indicate that the market is going up. So as long as you understand the market's going up, you should be able to picture that this is a high, that this is a low, and then once we get the market to close above this high, we're in fact in an uptrend, or in theory in an uptrend, because the market can um, reverse. But for for the purpose we're in right now, let me just stay on track. Um, Now, when the market gets up here, this is obviously considered a higher high because it's higher than the most recent high. Pulls back, and that would be a higher low. Excuse me. So we get another break of structure here. Why did I do that? We got break of structure, break of structure. This is a higher high, so I'm gonna put that here. And then we got higher low. Then we got another break of structure here. Obviously, this is a higher high. So this is the fact until we get, I'm going to introduce to you guys, if you guys don't already know this, this is going to be called the, this is going to be called the MSS. What do you think MSS is in reference to? All right, so this is a market structure shift. Why is it the market structure shift in a bullish in an uptrend? So it's the market structure shift because the market shifts from being bullish to bearish. So it was continuing up until it stopped continuing up. So the market fails after creating the higher high, and it ends up breaking through the structure that it once created. So that's the market structure shift. Now, what happens next is that now you have a low, then you have this is a new low, then you have a um lower high. So this is a lower high. So it's just the opposite. Lower high. This is a lower low. This is a lower high. And then you got a lower low. Just to refresh your memory, the market came and created this higher high, broke and created the market structure shift after closing below that higher low. Now you've got the low here, from the low here, pull back, creates the lower high only because it broke structure and created this lower low. So we're gonna just copy the break of structure concept from here and then paste it, and then vice versa for here to here. Now that's what we're looking at, right? Not it's not perfect, but it should be able to, it should give you a good idea on how this works. I don't know. It's almost like trigonometry. Kind of reminds me of trigonometry. I wasn't the best at trigonometry. I wasn't the best in school. I was pretty good in sales, but that's all I really. So I think honestly, um, maybe, and I'm still working on risk management, so I'm not the best, but I'm at least at the point of being a profitable trader. So, uh, yeah. Now that is the lower low, lower high, lower low. So let's take a look at how this would work if we were shifting from the downtrend to the uptrend. We already did uptrend to downtrend. I'll continue this until the market starts shifting from downtrend to uptrend. So I'm going to add a few more just so I don't have to start all over. This being the lowest low, this being the market structure shift. Perfect. Now, what do we have here? We've got a another lower high here, another lower low here, another lower high, another lower low. And then we can't forget about these breaks of structure. The breaks of structures that are happening. Then we get the market structure shift. That happens at this price point here once we get the close above. Pull back. Let me just interpret this real quick. This is our high. So since it's a new high, the newest high, instead of low, it's going to be just called the high since it's a brand new high. Now we've got a brand new low. And then we've got, continuation, market continuing to then create higher highs and higher lows until the market doesn't. Boom. So now that you got the concept, here it is. All right, should align with how you interpret the market. I put this in the education hub in my Discord, but for those who didn't see it, here it is. I don't know if the Oh, maybe 5 minute would make it look better. I don't know. That's pretty much how it is. If you want to kind of interpret it better, maybe pause it so you can see it. So yeah, that is it's the way that I interpret the market, as well as many other traders interpret the market, especially those who are price action traders or technical analysis traders. And not there's also people or traders who are both fundamental and technical analysts or um yeah, analyst traders or price action traders. And then there's also traders that only do fundamentals, and then there's also traders that only go with price action. So you can honestly, great part about this space is that you can choose whoever you want to be. You can be a day trader, you can be a swing trader, you can be an investor, you can be whoever you want. Sky's the limit. Um, you can be a scalper, anybody. Um, so yeah. Plus, virtually you can make as much as you want to. So, um, you can make as much as you want. You can work anytime you want, unless, I personally don't trade over the weekends just because there's certain markets that I trade in are not openly accessible to trade on the trading platforms that I trade. Um, indices, metals through, trading platforms that I personally use. Unless if anybody knows of any others that are open and allowing you to access to the markets off market hours, maybe, I don't know. I've used this platform, but I guess it was like a crypto Bitcoin or I don't know. I don't want to like get into it because it's hard for me to explain since I don't understand it. But I did see movement throughout the weekend. It wasn't only Bitcoin, it was also like gold, the price of gold. I really don't want to really get into it, like I said, because I can't really explain it. I don't even remember what website it was. But yeah, so that is pretty much that. I mean, structure, market structure. So I went over that. What's next? Next would be how about how about we do this? How about we do AMD, then mistakes or failures? Or how about before we even do that, I give you guys the idea of how it looks with through candlesticks. Market structure. I'm sorry, I didn't do that. So we're gonna go through candlesticks next of the higher highs and higher lows, highs, lows, things like that. Um, this took me a bit of time, a lot of charting, a lot of mental charting, real estate. I don't know if that makes sense, but just a lot of mental images that I've had in my head or back testing and just looking at market history to understand concepts. I even thought maybe even, at first looking at the Heikanashi candlesticks might even help get a bit of a grasp of the highs and lows that happen, such as this being a this being a low, this being uh this being a high, this being a low, this being a high, this being a low, this being a high. So like maybe it's a little bit easier for you to comprehend. Um, by using the Heikanashi. Since the market's already in an uptrend, let's just pretend it's not already in an uptrend. I'm gonna do high. This might take it might take you some time to understand. Personally, it did took me a bit to understand how this works, but the closest thing that I can tell you would be helpful for especially for new people is that maybe Heikin-Ashi candlesticks looking at it like that and that type of perception would help. Um then we got lower or higher lows. Now we got the uptrend. This is an uptrend since there's keeps creating higher highs and higher lows. This is gonna be a low. This is the newest low that happened, so it is the low. Now, unfortunately, the market never created a lower high, never created a lower high because the market broke structure. It shifted. There was a market structure shift here. The candle closed, this candle right here, it closed 10 o'clock. It closed above the most recent higher high. Um, so yeah, that's what made the market go back to being from bearish to bullish. So first it was bullish because it was creating higher highs and higher lows. Then it went from bullish to bearish because it created a new low. The new low was created because price closed below this wick of the higher low, at this candle right here, and pulled back, but it ended up pulling all the way back, closing out at with this candle above the higher high wick, and then price starts going up. So it goes back into this phase here. And with this phase here, you would consider AMD, okay? So A represents accumulation. These are the most common phases in the markets. Accumulation, manipulation. Then we have D as distribution. So with uh so with distribution, here's the deal with distribution. That is uh a pretty good phase in capitalizing. So first phase we have um this right here would be considered the accumulation phase. We're gonna mark this as accumulation. Accumulation would be pretty similar to consolidation. And when you think about consolidation, you think about maybe large gathering. Um, I think you know what I think? I think of zigzags. It really when you look up zigzags, you just think about it just being in one place. You're in one place. Um, just up and down or side to side. Obviously, you can't do side to side. You can't move side to side in the markets. The markets will either go up or down. So in the market terms, it's going to be um moving in place, up and down, moving in place in one place. So the market's moving up and down, not exactly sure if we're going up or we're going down. We're just maintaining almost in the state of homeostasis where it's a perfect medium between this and that, a perfect balance between A and B, a perfect balance between buyers and sellers, just maintaining price. So this is a common thing to look out for, watch out for. Usually when this happens, there's going to be something that happens afterwards. And many times people get stopped out of the markets because they might put, a buy stop, um, or maybe a sell stop here. Their order activates, but then, they're activated for, and then they think, oh, because we have a breakout, the market's going to continue selling. When realistically, if you were to short the market with a sell limit and then say, I think, we're gonna start selling if the market comes from where it's at after it breaks out, candle closes out outside of the consolidation area. I'm entered or I hit an instant um, market execution order as a sell, stop loss somewhere there, maybe above a candle wick, and then boom, market comes into profit a little bit, then pulls back and stops you out hitting your stop loss. Or you might have a stop loss above the higher high, you know? Then market pulls back and then boom, market goes the complete opposite way. So many times that happens to people. So just be mindful of I would say the higher time frame because the higher the time frame, the higher probability you have in the market going in your favor. So instead of looking at, focusing too much on the 1 hour, 30 minute, 15 minute time frame, 5 minute time frame, maybe just to get a bigger uh and better idea of the long term. I'm more of a long term trader myself. I think that I would consider myself a swing trader instead of scalper because I'm not looking to be in the market for only a few seconds or minutes. Um, Day trader would probably be in the expect to be in the market for probably less than 48 or even less than 24 hours, maybe a couple hours, or maybe I'm not sure if minutes applies to day traders. I think it does. Um, but yeah, if it's like less than 48 hours, typically you might be considered a day trader. If you're a swing trader though, I'm familiar with swing traders being considered swing traders if you're in the markets, usually holding the markets or your position in the markets for at least 2 days or over 24 hours, but less than a year. Um, if you're an investor though, usually investors are considered investors if they hold their positions. They hold on to their positions for longer than 12 months. So keep that in mind. Then we have, market, breaking that structure there. So after the accumulation phase, we get the manipulation. So the manipulation happens here. This is the manipulation. And we get distribution. All right, so here's the distribution. All right. Um, Manipulation or accumulation, manipulation, distribution. That's usually in that order what happens. Then you get either we either get a reversal or continuation. So that is usually what happens. Hopefully this opens your eyes. So I haven't looked at the like daily and stuff like that to try and catch this trade. So what I'll do is I'll stop see if I can catch this trade. So take it back off. So we're looking at price. Okay, so this is gold. Um, this one was pretty difficult to catch because it really didn't have much respect for, yeah, it didn't really have much respect, honestly. I remember that setup. Mm, let's say we're looking at, let's say we're looking at, oh, this is a Fibonacci. So for the Fibonacci, I normally would only use this. This is my settings for my Fib, just so you're aware. I got the charcoal black type of background, um, as my like as my background so that it's not, a bright background to hurt my eyes during like London session. Sometimes, the market while I'm sleeping would hit my price, that I'm or my area of interest with a certain security, and then, the alert would ring off. I'm opening my eyes while, after when I wake up 3 a.m. in the morning. I don't want to wake up to bright lights, flashing my eyes. I want to be able to, wake up a little bit, look at the market without hurting my eyes, because the bright light is painful when you're looking at, a really bright colored screen. Even my colors of my candlesticks, they're there because they're that way and not bright blue, bright red, bright green, bright red, because not only for, protecting my eyes from being harmed, but it's for maintaining and having a better emotional regulation or just having an emotional flow, allowing my emotions to be consistent instead of all over the place. Because if I see a sharp red candle shoot down when I'm looking to buy or I'm in for a buy, I might panic and then just close out my trade. But not always, but I just get that feeling. And when I get that feeling, it gives me the urge to exit the market. And if you have the urge of exiting the market when you're trading all the time due to color, it's like, why not just change the color? Change it to a more maybe I don't know, dull. Maybe dull might be the word to change it to a dull color. So same type of color, green and red or uh, blue and red, but just a little bit dull so that it's not affecting you mentally, psychologically or emotionally. Because obviously as a trader, you're an independent thinker and you don't want colors to get in the way of your profitability. Um, so yeah. Next is this well, I explained the Fibonacci retracement, but we'll talk about, how I'm using it. So many times I'm staying on the daily chart to interpret the overall direction of the market. And let's say the market comes to this point. At this point, we're implementing time frames. So different time frames. Normally, I'm looking at the market in terms of the direction. Right now, since we're making higher highs and higher lows, we would anticipate to bring this higher low. So I'm going to start from scratch. So since we're anticipating, we see the market where it's at right now. We're even above the EMA. I use the 50 EMA. It's not a secret. That's usually the only indicator that I'm using is the EMA, the 50 close EMA. This is my settings and no gaps candles. I got this idea from Alex G. 'Cause sometimes, if the market gaps up, it won't show you the candle at all. This, in fact, it shows you the candle, physical body of the candle. So I use this as well. Um, Other than that, I don't use anything else right now. And it's been working so far, so I'm just not gonna break not gonna fix what's broken. So we pull the Fibonacci retracement from this low, this is a higher low, considered a higher low, to a higher high. And from the price going from here to here, pulling back, we're looking for the market to at least like level out. And when you hear the words level out, you think of oil and water. Oil and water. Well, I think of oil and water. I don't know what you think, but I'm thinking of oil and water, like a mixture of oil and water, a perfect balance of, might not be the ultimate perfect balance, but what happens when you put oil and water in the same cup together? Usually, I mean, if you have the same amount of oil and the same amount of water, it'll, on average, level out to at least 50%. It'll look pretty similar to this one right here after you've done that. So, a mixture between buyers and sellers, right? You're gonna pretty much see something like that. This is how I personally interpret the markets. I'm looking for, you know, I think the virtually, everything has pros and cons. I always think, with good there's bad, or with good there's evil. Um, as above, so below. I also believe in, buy, sell. Like when you have one thing, you have the other. Um, you know, you there's usually not all good. Like a lot of businesses also don't have all good. Even in the, in almost every industry that I can think of, when there's good, there's also bad. Like in the insurance space, the good is that as a consumer or as a customer to buy insurance, it's great because you get coverage. But at the same time, um, depending on your coverage, mm, there you might have a HMO EPO, right? So you're restricted to your zip code or area for the most part, most of the times. Um, so that could be a con. If you are looking for another pro in addition to that, it would be changing your network from HMO and EPO to maybe deciding to go with a PPO. But at the same time, the con to that would be many times you got to pay more for a PPO, or maybe you got to be healthy enough to qualify for the PPO. So just keeping in mind that when there's good, there's also bad, right? So if we have this, at least have a concept of there being good and bad on two different sides, we can at least get a grasp of, hey, maybe if the market is buying, there might be, some sellers that want to participate or close out their positions, which would cause the market to start trickling down before more buyers enter the market during this uptrend in the example I'm presenting here. So maybe, there's hedge funds that are closing out positions and causing the market to start trending down. And during this phase, let's say this is accumulation, manipulation, distribution. We've got accumulation, manipulation, possibly distribution again. So during the manipulation phase, we might scale down to, I would personally scale down to, let's see what the 4 hour looks like. 4 hour seems to be still bullish, even respecting the EMA. Because if you look here, you'll see this is a low, high, low, high, possibly going to create a low here on the 4 hour time frame so that we can continue in the uptrend. And then we go down to the 1 hour time frame to see and look for a shift in structure because obviously we've got the 1 hour that was bullish. It was once bullish to breaking structure here, now creating a lower high after creating a low, creating a lower high, then lower low, lower high, lower low. Now we need structure to break here. So Once we get that shift, or um, not even just once we get the shift, once we get maybe an engulfed candle. So this would be the candle we look out for. Uh, Engulfed candle, and I would look for a bullish candle to print above this wick. The wick here is 2657.9. This is the candle that closes above. So I would enter a position as soon as this candle closes, stop loss below, because now there's a expectation of the market changing character, shifting in structure. This would interpret the engulfed candle. This one right here, it was engulfed because price didn't close below it. It closed above it, especially with the bullish candle. So took out that low, closed above the high, and now we're going up. And now we're in the market. So I'm gonna fast forward a little bit and look at the risk to reward. We're looking at a 1 to 3. This is a perfect risk to reward. Perfect. Like I don't I don't see anything wrong with this risk to reward at all. Now, if you want to see how long it took from where it was at, from where we entered, let me start that over. I use this measurement tool. That's It'll tell you how many days or how much time. It's been 6 days that we're sitting here. So just keep that in mind. If you are open to trading the way that I trade, I'm on higher time frames. So um, many times to allow the market to play out and hit your risk to reward takes a bit of waiting. I personally don't mind. I'm not looking to get rich quick anyways, so uh yeah. All right. This indicates that I might as well be open to and share with you guys risk to reward. I was gonna put this in there for one of the other one steps, but look at this. So this would give me a reason to enter the market again. Just keep in mind I'm using proper risk management, so I'm not trading the way I used to trade. Um, so hear me out. Let's say my account's equity, right? Accounts equity, and accounts equity would mean that this is your account's balance or the amount of money you have in your account, your trading account. So the amount of money that you have in your trading account, for this example, we're gonna use $1,000. I know we all know $100 nowadays isn't that much for people, so um everybody has $100 like on their um in their car, under their bed. So let's go with $1,000. That's how much is in our, accounts equity. Now, we're using proper risk management, meaning we're not looking to just full pour and blow the account. We want to act as if we are already a successful trader. Traders don't act with improper risk management. Although we have, Jesse Livermore, who, I mean, he was one of the most profitable traders, but at the same time, he didn't have proper risk management, was probably the reason why, was likely the reason why XYZ, I'm not gonna get into that, but you kind of get where I'm going with that. And if you don't, just do your research. Um I'm actually or I'm currently in the process of reading one of his books. Um, it's in my book bag. All right. So now we are looking at okay, yeah. So here's the deal. I'm risking I'm risking on average 1% on the trades that I'm taking. So 1 to 3, right? If I lose, if price hits my stop loss, I lose 1%. So 1% of the account's equity on $1,000 account is gonna be what? It's gonna be $10,000. So if it hits my stop loss, if price hits my stop loss, I'm gonna lose $10 from my $1,000. If I win, I'm gonna gain. It's gonna be take profit 10. Oh, take profit. I'm gonna gain $10. So we're gonna put a plus. This is basic mathematics, and this is what most traders why one of the reasons why most traders fail. This is compound interest, right? So if you maintain this idea, it'll take you very far in the trading space. Now, since we figured we entered here and the market shouldn't go below this low, um, now we know if we take a better look, we can see that the price here is priced at 2659.8. Now, the market came down to this wick here. But this wick, even if I show you here, the market never came below that low of 2646.2. It came down to 2647.3, which is higher than this wick. So at this point, we're still in the market. We haven't gotten out of the market. Again, on this $1,000 account, we are risking $10 for a reward of, I'm sorry if I put 10, it should have been 30 because this is a 1 to 3 risk to reward. And we know that it's a 1 to 3 risk to reward again because our entries here at that candlestick, stop losses at that price, our take profit is the newer high. We're expecting the market to continue in an uptrend. Now that we're where we're at, many traders, especially, traders like myself have gone through this where price would maybe consolidate or move around and look like it's headed for a stop loss. Many traders, including myself, fell or fall victim to closing positions because we feel like, we made a bad decision. Just think about it if you're someone like myself who swing trades, 7 days in the market, it's been a week and the market has came down to close to your stop loss. You might be like, I waited all week or I waited over a week just for the price to come back to my past my entry, close to my stop loss. Maybe I'm just gonna walk away with the L. It's been too long. But you don't really want to think of it in terms of how much, the way that I think about it is I don't want to think about how much time it's taken me to get the win. Um, I usually just, let it cook and see what happens. My idea of it is just risk to reward. I just think of it in terms of risk to reward. That's specifically even why I strategically made my username AntR2R. Ant risk to reward. So we just want to think in terms of R to R. What's the risk to reward? In this case, it's 1 to 3. So our 1 to 3 would be considered our risk to reward. And my idea of risk to reward is always, if not always, usually going to be at least 1 to 3. If it's an A plus B plus setup, it's going to be a 1 to 3 risk to reward. Um, at minimum. Bare minimum, no less than 1 to 3. Meaning, and I'll get into it. But here's the market. So look, we lose. We lost. Candle closed and even hit us out. We're not even gonna enter this market because it's quiet. Again, I didn't mark this up, pre-mark this up. Um, so that means that we lost $10. Now, if you over time, and I want to make this as transparent so that you understand that I not always, I also take losses in the markets. But on average, in the long term scheme of things, you'll see that I end up being profitable uh over time. So if we take a look at my TradeZella, you can see that I usually use TradeZella for my journal. So you can use Notion if you want for journaling, but I personally use TradeZella. So I use TradeZella because it's more automatic, I think, um, because you can do the integration with your broker account integrated with your journal account so that the trades you take on your trading platform, it'll automatically update in terms of wins and losses. So you get a grasp of an image of your profit and loss statement day by day, month to month, week by week, year to year. So this is just something to think about. Yeah. Um, I'll put the link in the description for the TradeZilla. And let's take a look at why risk to reward is even important. So I'll get back into the TradeZilla, but over time, if you think of the market in terms of this way, as having a better having better risk to reward than a 1 to 1. So let's say 1 to 1 would be if you're risking mm, we're gonna go with mm, let's say let's say we're a farmer. So as a farmer, farmers plant seeds. All right. What do what do we know seeds for? We know that seeds are usually planted so that we can get something in return. In return, we get more we get more product. We get more plants to grow. Right? So without the risk, there is no reward. So in this case, what I'm going to use is a 1 to 1, and I'm really not sure what this is, but I'm going to add it here. We have 1 to 1 in terms of in this case, we're going to just make believe that this is a seed. So in this case, we have two seeds. This is a 1 to 2 risk to reward. And then in this case, we have 1 to 3, right? A 1 to 3 risk to reward. So each time we're trading, we're putting something at stake. We're putting something at risk. That is the one. The one would be um your risk percentage. That's going to be on the left side in this case. On the right side, that's going to be your risk percentage times 2. So I don't know why this is still two, but yeah, three. So obviously, if your risk to reward is a 1-to-1, your reward is not as good as 1-to-2. And obviously, if you have a 1-to-2 risk to reward, your reward is not as good as a 1-to-3. So the higher the number on the right, the more equity you gain, the more in return you're able to get. And that means the more you can compound your account, the more seeds that you get from the new fruit, right? Because if you plant apple seeds, if you plant only one apple seed, you're gonna get something in return. You're possibly gonna get something in return. There's no guarantee that the planted seed will grow. So there is a chance that you're taking. You're risking time. You're risking time equity planting the seed to expect a return of more apples or another apple to grow. If you risk 1-to-2, right? If you risk the same apple, let's say you're risking 1%, so one apple, um, for a potential profit of 2%, which would be you might get, two apples in return. Um, if your reward is, since you have a bigger reward because you have more seeds to plant. And then for 1-to-3, you have three apple seeds to plant. You know what? What I'll do is I'll just use the apple emoji. Apple emoji. I think it's easier to comprehend. Should have done that in the first place. I think I want to explain this so that a kindergartner can understand. I want more people on my page than, there is because we need more people to be on the same page nowadays. With interest and all this going on. So inflation and all that's going on that we have no control over or virtually no control over. Um, yeah. So these are just, apple seeds that we're planting here. Back to what we were talking about. So you plant one apple, so you risk 1% for another profit of 1%. That's possible. Um, you plant two apples, right? For the same percent, you're risking 1%, which is the time equity, and then two is going to be the profit. So there's always going to be something at risk. Time equity in this case is on the left side. Right side, we're going to have money, account equity. I'm just going to put dollar sign right next to it. Account equity. So you have something at risk for, and it's okay to have something at risk. Like life is risky. I'm sure we've all heard that life is risky. Getting a job is risky. You don't know if you're gonna get, um, fired. Like you don't know if AI nowadays is gonna take over your job, stuff like that. Like almost everything is risky. Most things are risky. Living life is risky. Crossing the road is risky. Driving is risky. Like we have driving records indicating, who's higher risk than others. We have uh drivers records indicating that more males are have higher risk being on the road than females at certain ages. That's just what it is. It's just statistics. Like there's risk. Like, but if we all ran away from risk, then we would virtually go nowhere in life. So many people take risk. You can't live life without risk. Um, so yeah, we're risking time equity. So we have 1% all the way around. Again, on average, I'm risking 1% per trade. So 1% is my time equity that I spent, the way that I look at it. Time equity that I spent is the 1% to figure out if I want to buy or sell. Then the number on the right is going to be the account's equity. So if I win or lose, in this case, I if I lose, I'm down 1% on my account, which is negative 10% or negative $10 on this $1,000 account trade or account's equity. Either we lose 10 or we gain 30 is number for the third option. Since we're on 1 to 1, what would it look like? It'll be the same stop loss every time. Negative 10, or in this case, it's not going to be negative 10. It'll be 20 plus, not 20, plus 10. This is it's not a broken concept, but it'll just take you, it could take you longer to be profitable because especially if you have a low win rate, it'll take you a lot longer than just focusing on 1 to 2 setups. Now, if we did 1 to 2, that's going to be the same time equity in, you know, in the way that I picture the market. I picture the market again in time equity. For the left side, right side, I picture it as account equity. And that's going to be 20. So, excuse me, that's if you took the 1 to 2. And then obviously vice versa. You can keep on going, only taking 1 to 4s, only taking 1 to 5s, or not even only taking, right? Because if there's a 1 to 3 and you focus on 1 to 3s, obviously you're not going to miss the 1 to 4s and 5s and 6s. But you can create a very precise line through the middle of what you're going to stand for, what boundaries you have. My boundaries are that for an A plus B plus setup, I'm not going to take a 1 to 3. And when I see a 1 to 3, I'm gonna risk you know given amount, let's say 1%. Maybe if you see a 1 to 2 or 1 to 1, you're gonna scale down your risk and you're not gonna risk as much as you would where if you were risking 1 to 3. So, if you're looking at a 1 to 3, might risk 1%. If you're risking or if you're looking at a 1 to 2, 1 to 1, I might risk 0.10%, not even 1%, not even 0.75%, if that makes sense. So that's how you would think in terms of risk management and R2R, risk to reward concepts. So this tremendously helps. This is probably the most important concept, mental framework that I think people should have, where it changed the, you know, um, the trajectory of the way that I trade and my profit and loss statement. So we're gonna go back. Like, this is why it doesn't matter if it hits your stop loss while taking a 1 to 3, because if you're trading with the trend, I showed you a realistic loss that I probably would have had if I looked at the market, the way that I did. This is realistically what happens. Boom, I lose 1%. Well, I mean, if the market went in my favor, man, I would have gotten uh $30. Unfortunately, I lost 10. But if I was right and there were more buyers in the market, I would have been up $30, which would have brought my account's equity instead of 990, where it actually happened in this case. It would have been $1,030 instead. So think of it in terms of that way. It'll put you from being a trader down here to levels higher. It's almost like thinking with, just higher frequency. But you want to be consistent, because if you're inconsistent, it's not gonna probably not gonna be, honestly, if you're not even gonna be consistent with trading, honestly, I don't even suggest trading. Like, just trade on a demo account. Just trade on the demo account or don't trade at all if you're not going to be consistent. Like it's a waste of time if you're not going to be consistent. Um, but yeah. So that's that. See if there's anything else. Uh, I gotta go back. Hmm. We gotta find, here it is. See what else is over here? Mistakes and failures. I mean, mistakes would be what I mentioned. Mistakes would be exiting and not allowing, and I still fall victim to this till this day sometimes, and I'm constantly improving and being aware, because the first step is being aware that you're making this mistake or this failure that constantly happens. Many times it's in the moment and it could be emotional for you, but so that you can at least be aware of this failure that keeps on happening and you have control over, and it's almost like you're fighting your demons because you want to be as objective as you can when it comes to the markets because emotions don't win in this arena. Being objective, if this happens, then I'm getting out. If this happens, then I'm staying, I'm staying in or not staying in. But if this happens, I prof or I lose. If this happens, I win. Just making it as objective as possible. Setting boundaries is the easiest thing to do. Common one again that I'm facing right now, which isn't as bad as it used to be, but I've improved, and I know I've improved because I've been journaling. Um, is closing my trade when